We're now going to move on, and I'm very pleased to welcome to the podium Mr. Chidu Narayanan. Mr. Narayanan, economist at Standard Chartered Bank, who will provide us with some market context with his presentation, Global Trade and the Macroeconomic Environment in 2021.
Hi, good afternoon, everyone. I presume I am audible enough. It's always a tough act following a very interesting conversation like that and doing the pre-lunch talk. It takes a brave man to stand between hungry people and lunch. So I'll try to keep my bravado to a minimum. I'll try to keep it to a 15-minute presentation on broadly what we think about global trade over the next 3 segments. Over the near term, over the medium term, and how we think it might be evolving over the long term, and as well as touch upon a couple of key macroeconomic insights that might affect the outlook for trade. Okay, what we've seen so far over the last maybe 1-2 months from the end of March last year till about right now, we were hit with the worst economic recession we've seen since at least the World War. We've had a massive contraction. Global economy contracted by about 3.3%, and as a result, very obviously, trade declined very substantially as well. There was lockdowns last year. Activity declined, sentiment declined, and as a result, if you see the chart on the left, especially this particular decline, this particular dip, this is the first dip in actual trade volumes that you've seen. This is the first dip in actual trade volumes that you've seen at least since the global financial crisis. So volumes dipped very, very sharply. But what is different last year with this particular pandemic from previous crisis is that the rebound was as sharp, as quick as the decline was. That usually never happens. It's a much smoother, much more gradual increase in volumes. And the biggest driver of that has been the pace of the US recovery, the resilience of China. Both of that driven very substantially by huge, incredible fiscal policy and monetary policy support. And Reyes did talk about the huge money supply that we've seen. There's been massive amounts of stimulus that's been pumped in by both governments as well as central banks. And that is what has kept us afloat. And we've seen volumes rise up already. But enough about what has happened so far. What could be happening over the next few months? So what we think is that over the next 3 months at least, we will see a rapid increase in trade, in global exports. And the reason for that is not just because recovery is happening. We think that will happen whether or not global demand picks up, purely because of a base effect. We had a massive contraction last year, right? We had the lockdowns, we had activity decline substantially, particularly in Q2. So this year, in Q2, even if there is no change, even if volumes remain stagnant at, say, September last year, we would see an increase in trade by about 8.3%. An 8.3% year-on-year increase if nothing happens, if nothing good happens, and nothing bad happens either. But what if we account for the stimulus that has been pumped in? What if we account for the increase in prices? So crude oil prices averaged about $40 last year, in the first half of last year. This year, it's already running at $60, $64. Let's say there's only a 25% pickup on average. Let's say with this current increase in infections, prices drop again. If there is only a 25% increase, we would still see a 35% year-on-year growth, a huge 35% year-on-year growth if nothing happens and oil prices actually drop from here. If volumes pick up and oil prices increase, then we will see an even bigger increase. And that's our base case. The the outlook is optimistic, at least over the near term. Over a slightly longer term, we think that that's still supported, because what are the two biggest drivers of global growth? It's the US, it's China. What happens in the US, what happens in China, that's where demand originates from, and demand is really the driver of all activity. And we've seen the chart on the right-hand side where you see the PMI, which is a sentiment index, which is what industries are thinking about in terms of the outlook for growth. That is directly correlated with activity, with actual real action. And if there is industrial activity, there is going to be exports and there's going to be trade. And the pickup in US PMI, the pickup in China PMI means that the near-term outlook is very, very, very optimistic. And that's what we see in terms of global growth as well. US, by our estimate, is already back to pre-pandemic levels. So the levels of activity in the US is already back to pre-pandemic levels. China never contracted last year, so China is doing better than it did in 2019. So you have the two major economies still doing already better, and that is only likely to continue through the rest of the year. In the US, we've had this very strong recovery, supported initially by the government and the Fed pumping in dollars, but the very rapid rollout of vaccinations, the very successful vaccination rollout that they've had, and as a result, the successful decline in new infections that they've had in the US has also propped up sentiment, and that's a very, very important factor. Forget infections, forget actual vaccinations, forget activity. If sentiment is subdued, activity will not prolong for too long. Whether there's money in the market, whether there is support from the government or from the Federal Reserve, if sentiment is subdued, that will not lead to sustainable increase in demand and sustainable economic activity. And that's been the biggest improvement, particularly in the US. But will that continue for longer? That's the big question at this point in time, particularly, because we've seen this huge increase in infections already. The US has been okay, but we've seen infections in India, we've seen infections in Turkey, we've seen infections increase across the region here. And that's also worrying because recent reports suggest that the Indian strain could be immune to the vaccinations. So even if people are vaccinated, you could be having infections. Again, so these infections might not necessarily have the same fatality as before. It might not necessarily be as serious as before, but the impact is on sentiment. If people are afraid that if you go out and get back to quote-unquote normal activity, and that could lead to the risk of infections, people are going to curtail that. We are probably lucky that we are sitting in this conference, being able to see each other in person. One of the very, very few countries where you can actually still do that. If infections do increase again, a third and a fourth round of infections, this is not going to be possible. The expectation that you can get back to normality is also going to decline with every successive round of infections. And that, again, will lead to a decline in sentiment. People might have money, but they will not be willing to spend it, exactly in line with what Andreas had described in the previous session. So that is a big, big potential downside risk. And that's something that we're very, very cautious about. We are seeing some difference between the haves and have-nots in terms of who has the vaccinations, who has access to the vaccinations, who has access to the raw materials for the vaccinations, and who does not have that. So that's leading to one other divide. And that has actually accelerated one other trend that we've seen even before, but that has been accelerated purely because of the pandemic. And that's what the pandemic has done. It has accelerated this trend of nationalism, this trend of protectionism, this trend of countries being more worried about their exposure to other parts of the supply chain. So in the years from the time China entered WTO till, say, about 2010, 2012, you had this massive increase in global trade. Trade to GDP rose rapidly because you had the boom of supply chains, you had an iPad which is made of 200 different parts, 200 different components from different parts of the world. A car that's manufactured, say, in Germany, which has inputs from all over the world, from Australia, from Brazil, all parts of Asia, all parts of the US, China, eventually ending up being manufactured in Germany and being sold in the US. So you've had that sort of a global supply chain, but that is rapidly changing. And the pace of change it is always happening. The pace of change has been accelerated because of the pandemic, because one, pre-pandemic you had the US-China trade war, so people are already getting a little protectionist. The pandemic has brought to light the risks that could happen with your manufacturing if you're dependent on inputs coming from Australia, inputs coming from China, manufactured in Vietnam, and so on. So what countries are moving towards increasingly, and that might be something that we see. I don't profess, again, to say that this is what will happen. We are already seeing signs of change. This is something that could be happening over the next 5 to 10 years. Increased regionalization of supply chains. Moving away from a global supply chain to a local supply chain, focus on friendly countries in participation in the supply chain, focus on regional partners. So you could have a localization of supply chains in the Americas, in Europe, in Asia, focused on catering to demand in these regions. This was already happening just so that you could increase the pace of reaction to your markets. If you could manufacture in the US products that are demanded in the US, you can respond to market requirements and changing market demands that much quicker. So it was always happening. It has just been accelerated because of the pandemic. And the other aspect that we are seeing now is moving away from a just-in-time sort of inventory management system to a just-in-case sort of an inventory management system. So corporates, industries are no longer doing exactly what is required based on modeling. They are moving more towards what if there is a pandemic elsewhere? What if there is increased geopolitical risks in other parts of the supply chain? Let's maintain a little bit higher inventory. Let's manage a little bit more just in case, even if it leads to a slightly increased cost, just so that you can cater to demand and hedge your downside risks. I'll probably stop there. Maybe just one final comment on the macro theme. One thing that we are worried about, we did discuss briefly on inflation. That's the theme that has come up very substantially over the last 3 months, say from end December till all of March. And over the near term, we think that inflation could be going higher purely because of base effects. Nothing happened last year. Activity happens this year. That will push up inflation. Central banks are not likely to be concerned about that because they do know it's a base effect. They likely look past that increase in spike. The question is, does this massive amounts of money in the system, does that lead to inflation? And large parts of the market does think that will happen. We don't necessarily think that. And the primary reason for this is one, the velocity of money that Andreas described. It hasn't really gone into fruitful investment. If the government spends, say, $100 billion and people pocket the $100 billion and do not go out and spend, it's not going to lead to activity. If corporates do have the money, but they're not going to invest, it does not lead to inflation. And corporates are still not very keen on investing. They're very, very concerned about investing because they're overcapacity. Large parts of the global economy are still below levels of activity that we saw last year, which means that investment is low, which means that the pace of inflation will also remain low. It could change over the next 2 to 3 years once we're closer to normal levels of activity, once we're closer to pre-pandemic levels, and that could push up inflation. And then you could see a rapid unwind of all the support that we've had. So that's a risk that we're cautious about, but we don't think it's going to happen over the next, say, at least over the next year. I'll pause here. I think I'll stop here. Maybe if there are any questions, I could take them.